Hey, traders. Happy September. Great to see you all. Welcome to Charts and Coffee. We are releasing the Kraken as we get into the fall trading season, kicking it off with the ADP release, which was a pretty significant miss this morning. Which, look, misses in data are generally going to be pretty bullish for equities because we're dealing with the situation where, as we're moving towards taper, what's going to be the amount, what's going to be the pace, and when is it going to start? And generally speaking, weaker data, misses in jobs, inflation growth is going to likely push it further back into this year in terms of start date. And it should not be any more aggressive than a $15 billion reduction in asset purchases every meeting, not every month. And so any change to that is likely going to be based on what's happening in the data. And any change to that that's slower, equities are going to like. And so a weak ADP, possibly a weak non-farm payroll could push it further back into the year. Certainly, probably no sooner than November. All right, so that's where we sit right now. Still very bullish on equities. No reason not to be. The structure's there, and we will continue to follow that structure. So let's get on over to the questions. Thanks for joining us for Charts and Coffee. Really excited for the fall trading season. You know, I'm pleased with the way we navigated August. I'm not thrilled. I'm never thrilled. I mean, I think that if anything, I could have pushed the accelerator a little bit harder. I'd try to look at what I could have done better, things that I don't want to do again. And luckily, things I could have done better was a longer list than the things that I should have not done. As long as that second list, the things that you should not do, it's not a big list, you're doing all right. Okay, so let's get to it. Great to see everybody. Peter, hi, long, Square. All right, so I've been getting some questions on Square. And I will tell you, as far as the structure of Square goes, take a look here. We have what I have to look at and view as is clearly a market where the path of least resistance is to the upside. Is it an uptrend? No, but as you can see here, between July 22 and August 17, we went into a double green, 8 over 13, 13 over 21, 21 over 34 structure. Bullish. Double green, that's my bread and butter environment. If you look at, and this is not everybody, but I would say most of the folks in this room with us right now, if you look at your P&L, the best uptrend you're going to see on any chart, if you see that P&L growing, it is very likely going to be that generally the markets were in a double green and the ETF stocks, futures, currencies, whatever you were trading were also double greening. We're going to turn it into a verb in September. They were double greening as well. So if they're double greening, you're on the right path. And that's the structure you want to prioritize. But sometimes you're going to notice we transition out of the double green. Does that mean we start to short? No. It just means we know that the uptrend has lost a little bit of its swagger. And it means that we should wait for deeper pullbacks. And so it's a good long. It's a good long, Peter. I like the overall direction. Hey there, Debbie. Thank you very much. Yep, thank you very much. So today's my birthday. Thank you. I appreciate that, Debbie. So my partner here in the office, Trish, she always says she breaks it down. So she'll say something like, oh gosh, she's really good at it. She'll say something like, oh, it's my 3515 birthday. Something like that. It's hilarious to me. Anyways, yes, it's my 3515 birthday. So question is, October is less than 45 days out. Yes. When do we start looking at the following month for the expiration? So 45 to 60 is, as you know, where I like to be, so that theta decay is not crushing our position, because we're looking directional. We're focusing on debits, and those are very sensitive to the fact that options are depreciating assets, right? So I would love to start looking further out. Some contracts we'll see there's November. Some we'll see we have to go straight to December. We have to focus on the open interest. So if I don't have open interest in that November or December, whatever it is that ETF or stock is offering, there's no open interest at the strikes that I want, I'll have to stick with October. I don't want to necessarily focus, but 45 in those, 40-ish, we might have to focus on October for now, that October 15 expiry. But I think I'm seeing more and more in November and in some cases December. So I think we should be all right. But there will be that lull, as you've probably noticed, when we haven't quite stopped trading October as actively. We haven't moved out to the next contract month. So we might be in that funny little window, but it shouldn't last very long. So thanks for the question, Debbie. Terrific question. All right. PH asks, using your JT multi with a slow stochastic is helping me to identify exhaustion points. Love it. So let me give you an idea of what PH is talking about. Thank you, PH. 19 is my favorite number. That was my number in high school for volleyball, for soccer. So PH 19 asks about the stochastic, or mentions about the stochastic and the JT multi. So what's that killer combo for that? It is the yellow JT multi, preferably yellow over yellow, but definitely the lower row. Now, if you don't have the JT multi, I know some of you might, some of you might not. It is now in the bundle. So if you haven't checked that out yet, I know it's if you've seen the emails, yes, it's the bundle offer. But what I'm actually more excited about, and I know I have the link here somewhere, but we'll just throw it up on here, is I'm actually really excited about the live trading session, because 2 live trading sessions, because what we're doing for the first time, as many of you probably already know, is we've got the bundle. We've always had the bundle available in the store, but this is the first time that we get 2 trading sessions where I get to walk you through the way I used them intraday and the way that I used them end of day. And so it's going to be not only instructional in terms of settings and what to look at, it's also going to be helpful for how I set up trades using them. So if you haven't checked out yesterday's free video at the Simpler Trading YouTube channel, I followed up on the IYT conversation, and I got into a little bit of JT multi. I got into the V-score and the VWAPs and the levels that I'm looking at on the IYT. So if you want to get a really in-depth look at some of the things that I'm looking at now, like setups potentially in stocks within the IYT ETF, and then the sector that the section of the chart that I'm looking at and why, check out that video. It should be super, super helpful. So the slow stochastic setting that I use, PH, I don't know if you're using a different setting. I love slow stochastic. If you don't have ready aim fire, the slow stochastic is something that I would recommend putting up. And I use when you look at the settings, just so you guys are using, so y'all are using it in a way that I think is, through years of trial and error, I think is the best, is a 2080, right? So that'll be the 80 on the upper end, 20 on the lower setting, with a 21K 3D setting. And that's what I've been using for a long, long time. All right. So next up, thank you for the birthday wishes. I appreciate that, Heather. Thank you. MRNA. Sure. I don't have any skin in this game, but what's happened yesterday, this would be the session for August 30. Tuesday. What the heck is today? Monday. Today's Wednesday. Monday and Tuesday. That those pullbacks, that for me, that weakness entered the zone, right? If we're batters, I love to use the baseball analogy. If there's an analogy that'll just beat into the ground, it's baseball. That is the sweet spot for me. That pulling back into the wave, not that different than what we saw on the 16th, saw it again on the 30th, saw it on the 31st. Those moves into the wave, that bearish momentum in the zone, that's what I'm looking for. So my thoughts on MRNA are that it's double green, went yellow. Yellow does not invalidate the uptrend. It just means it lost a little bit of swagger. Still buyable. Maybe be a little bit more conservative, maybe position size in a slightly more conservative way, knowing that if we head down to the middle of the wave, or the Darvis you see there automatically plotted. By the way, that's the new Darvis signals, which you see running on my trading view. That's in the bundle as well. So you'll notice that this is automatic. I'm not having to draw that in. There is nearly nothing. I'm trying to think of an exception that I draw on my charts. Everything's automated. And in the automation, is speed, accuracy, and probably more important than that is objectivity. I'm not being subjective. I'm not, even subconsciously putting in the lines that I want to see. I'm getting the lines that are there, right? So, the process, the automation doesn't care what I want. It only cares whether the criteria was met. So you'll see that Darvis might be really in play as well. But I like the buy. It's definitely a buy, but not on the moves higher and not higher from where we are now. Monday and Tuesday really were very nice candles for the entry. So timing matters, in the context of an uptrend, timing definitely matters, because if you habitually buy new highs, if you buy strength in uptrends, you have to calibrate for one of two things: taking heat while the market will sometimes correct, retrace, and also maybe have enough in terms of the budget that you're allocating to this MRNA trade to scale in. And I have a video on scaling in and scaling out that I did last Friday. So you get an idea of how I get into markets and how I get out of markets. It's always a scaling in and out process. So thanks for the question. I appreciate that, Furman. All right, Alex, I understand when trading options, our stop loss is 25%. That's usually where I stick with. Yep. So I want to have a defined risk for the trade. You got it. What do I use to calculate my stop loss? SLK? I don't know what you mean by SLK, or is that just a typo? What do I do to calculate my stop loss when trading futures? Oh, okay. So futures, they're different animals. When I'm trading options, and because I focus almost solely on long calls and long puts, right? And I'm sure you hear it all the time. Unless you're collecting credit, you can't win at trading options. You know what? I've got a room of nearly 700 people that are proving day by day by day that just ain't true. So timing matters, right? And risk control matters. So first of all, thank you for mentioning stop losses, Alex. I love talking about losses. I love talking about stops. That's the difference between a long career as a trader and a very short career. So the idea is, when it comes to a debit, right, we never want to max risk maximum debit. I've never understood that. It doesn't actually make any sense when you crunch through the numbers. If I've paid $500 for an option, I've got a defined risk of $125. Yes, it can be a little less. Yes, it can be a little bit more, but you will notice, and this is after hundreds and hundreds and hundreds and hundreds, if not thousands, of options trades throughout my career, I just noticed that when an option exceeds a 50% loss, it just usually doesn't come back. It's rare. The probability is far lower. And then when I looked a little closer, I realized, gosh, it's actually pretty low after 25 too. The probability starts to drop. So yes, there are exceptions, and the brain loves to remember those exceptions. Those are going to get us in trouble. So 50 is the absolute line in the sand. 25 is usually where I exist in options. Never, never, never as a habit, unless it's something like a trade that you're taking into a high impact economic event. Don't risk max. 50 is about where you should be. Even when I'm trading options into earnings or non-farm payroll or central bank events, I calculate somewhere worst case scenario about 60%. And that's knowing that I'm trading near lava, right? That's knowing that, and I'll still not risk 100. So with futures, it's a hard stop. With futures, it's price-based. It's completely different with futures, but the percentage of risk to the account rule still applies. Yes, you got it. Because risk of ruin is real. And if I think about, and the analogy that I use is 9 players on the field, right back to baseball, 9 players on the field. Each player has a job. If I think like that, I know I'm not going to get a lot of overlapping position. There might be a few, right? Outfield is kind of generally the same position, but there's still nuances to each, right? But I really want all 9 positions, all 9 players doing their thing with not a lot of overlap. Some is okay. A lot is going to get me into trouble. But 9 is important, because if I think about the maximum risk I don't ever want to be in a situation where, in the worst case scenario, this rarely happens, and I mean rarely, but if all 9 positions were to get stopped out, I don't want to be below 50% of my account value. This is basic risk of ruin arithmetic. So, that's where this conversation really goes. If the market does something crazy, is it going to risk your being able to get up and get back to work tomorrow? And risk of ruin is not blowing up an account is not zero. Blowing up an account is when you break the 50% barrier. And if you think like that, you'll never drive an account to zero again, because that 50% barrier is going to keep you from persisting with whatever the heck you were doing, that I was doing, that we were doing, that got us to that level to begin with. Okay, so thank you for the question. Amazon. All right, Alex, let's take a look at AMZN, and finally ready for some love. Gosh, I don't want to bet against tech, and I don't want to bet against the markets generally, but is it an uptrend? No. Is it bouncing off an oversold level? You can definitely make that argument. Is it a clean setup? Probably not. The best thing that I can say is that, look, here's one way to look at it. And this is the most basic way to look at something. It's unbelievable how much the 200, simple or exponential. I prefer the exponential, but simple is fine too. It's amazing how often people just don't look at something so elegantly simple, like whether or not price is above that 200 or below that 200. Now, propulsion, which is included with the bundle, all right? Propulsion, let me show you something here. Actually, this is really cool. Thank you for asking a question, Alex. Do you see how the propulsion was steady and lit up, ... And then what happened? It disappeared. So while the 200 is still important, I know when the dots disappear, we're likely not going to see the same respect for that level. And you'll see when the propulsion dots, which are really a smart EMA, they're a replacement for EMAs. So when the dots are lit up, we know that the respect for that exponential moving average is better. When the dots disappear, it's not that the EMA is not important anymore, especially at 200, and that's what we're talking about here, right? Especially at 200, but when we're below it, it's struggling. Not that I want to short this market. I'm not even allowed, not really, okay? But when we get back above it, there is a distinct sentiment shift. There is a distinct sentiment shift. So, there was a very brief downtrend that was trying to form. Here's the thing. And if you might say, Rag, but double red is a downtrend. Why wouldn't you short? This is where the sector secret, if you will, comes in. Do I want to short tech? Yes, there's some names that have been lagging. Tesla comes to mind. Amazon comes to mind. But where's the tide at? This is a boat, and a big one at that. But where's the tide at? The tide's generally moving higher. Do I really want to bet against the tide? I don't. And that's where these nuances and a very consistent process to directional bias is going to keep you out of trouble. And then that simple little propulsion and 200 EMA, again, dots are gone. We're probably not going to see the same respect, but being above or below that 200 will tell you a lot about sentiment. All right. Okay. So next question, Andrea asks, how much market exposure do I usually have at any given time? Well, when you say market exposure, it's not a matter of how many dollars I've allocated into the market. In fact, dollar allocation is very unimportant. Whether I have $500,000 in the market, whether I have $1 million in the market, whether I have $50,000 in the market, that's irrelevant. The percentage of the account, that's not even important. How much of that, but I like the word budget. How much of that budget is at risk? That's the number. So what I'm always wondering is what do I have at risk? And what is at risk is not 100% debit, because I don't play that game. Again, from a mathematical standpoint of what happens when options lose a certain percentage of their value, there's no reason to consistently be at 100% risk of a debit. That being said, it doesn't matter what we've spent. It only matters how much of what we've spent is at risk. So again, my positions are always in line with If for whatever reason something disastrous were to happen and just everything sells off, which doesn't happen for long, there's always an uptrend somewhere, which is true. When high beta, high Momo rolls over, defensive will light up. Sometimes when gold is up, dollars down, etc. There's always a trend somewhere, and market doesn't, money doesn't go into the mattress. So, I've got to think about defense versus offense. You'll see there, these are some of the notes for Sector Secrets coming up as we going to head into that room right now for our weekly Wednesday session. And we're going to talk about some sideways markets, the current uptrends, playing defense, right? So market exposure, again, if you go back to the 9 players in the field, they shouldn't be overlapping, because if you got too much in, you can't have 3 people on first base, right? Think of it that way. So if you have too much overlap, you've got too much risk. You have too many positions that could represent, if everything gets stopped out, more than a 50% loss to your account. Those are the levels that we want to steer clear of, right? That's the event horizon into the black hole that we want to avoid. All right. So thank you as always for joining me for Charts and Coffee. You got the Kraken on the mug today, releasing the Kraken. So I will see you all tomorrow, same time, same station. Thanks as always for being a part of the Charts and Coffee crew. Be good to each other. Happy trading. I'll see you soon.